Welcome to the Compliance 911 Show, a no-nonsense podcast discussing hot topics for today's busy compliance professional. It's everything you wanted to know about regulatory compliance, but we're afraid to ask. And now, here are your hosts, Dean Stockford of M&M Consulting and Len Suzio of GeoData Vision.
Welcome to today's podcast regarding the Community Reinvestment Act. This will be the 100th podcast by Dean and Len since they started the Everything You Wanted to Know About Regulatory Compliance But Were Afraid to Ask podcast 2 years ago. To celebrate this momentous occasion, Len and Dean decided to invite a special guest, Kenneth H. Thomas, Ph.D., the guy who really did write the book about the Community Reinvestment Act. Dr. Thomas is one of the nation's leading experts and authors on the Community Reinvestment Act. He has testified in Congress, advised regulators, trained federal bank examiners, and written numerous articles and 2 books on CRA, including the CRA Handbook. Many of its recommendations were implemented into current CRA regulations. Here's Len and Dean.
Welcome to today's podcast, Dr. Thomas. I have been really looking forward to today's discussion, and I know my co-host, Dean, also has been anticipating our discussion about a regulation, the Community Reinvestment Act, that's been around for nearly 50 years, most of which, during which the regulation was pretty stable. The last big change was in 1995. In fact, it was the only big change since the inception of the CRA back in 1977. But the last 5 years have been another story. It's nothing short of tumultuous change.
Yes, I too have been looking forward to today's conversation, Len. So this is kind of exciting. I know when we talked about it, sitting back, what were we going to do for our blockbuster 100th episode? So very excited to have Dr. Thomas with us today. Quite frankly, the gentleman who wrote the book with respect to CRA. So I'm quite excited about our guest and where we go. And I think it probably best, obviously, if we jump right into the NPR, the 2023 CRA rule that was announced, I believe, in March, that they were going to rescind the Community Reinvestment Final Rule that was issued in October of 23 as a result of recent litigation that was occurring by lawsuits that were filed. So I'm kind of anxious as to get the insight here on what does the NPR actually propose. And, I have to say also, I think and this is just a cursory opinion, and that is how important it is for bankers to listen to this podcast and act based on what we know today. And I think that's imperative as we move forward through our discussion today, that bankers, at the very least, the takeaway is take notes and get involved, because your advocacy agencies are certainly going to do that. It could be a complete PR nightmare if we don't pay attention and get involved in shaping CRA for the future.
You know what? I'll quickly jump in and just say, you're totally right. If you're going to be passive about this, I'm talking about the banking community, you're going to get run over by the community activists. So this is a great opportunity for the banking community to influence things. And there is a comment deadline on the NPR of August 18th. And listeners can go to regulations.gov and click on the CRA docket, and you'll be able to submit your comments. But I'm interested to see what Dr. Thomas has to say about the NPR, and I'd also be very interested in your comments, Dean, Ken, about the problems with the 2023 CRA rule, which is about to be repealed.
Yeah, I think that's great that he can chime in on that, Len. Also, the politicization of not just CRA, but just politics as a whole. So, Dr. Ken, welcome. It's great to have you. And we're really interested in seeing if you can break down this NPR, CRA, and its current state today, and talk a little bit about the politics around everything. That would be great, seeming how you are the godfather of CRA.
Well, first of all, thank you both for having me. I've been looking forward to this, and I've always been a great admirer of your podcast. I listen to them faithfully, and especially Len's writing on CRA. Always look forward to reading about it. But, you're right. I've been involved in this literally from day one, going back to 1977. And, I don't want to get into politics here, but I will say the one thing I admired most about Senator Proxmire was that he was a very rare commodity, something that we don't have today. Obviously, on the Democrat, he was a Democrat, head chairman of Senate Banking Committee, but very socially responsible. Not just CRA, truth in lending, and other very consumer-oriented laws. However, in the area of financial responsibility, like our budget deficit, he was a fiscal hawk. So he's probably more Republican than anyone else on the fiscal side. So find me somebody today who is, you know, a mix of a fiscal conservative and a social democrat. That's why I love Senator Proxmire. But the beauty of this law was, and I discussed it with him a lot, was that when he put it through, that it was really apolitical. It was not about race or anything like that. It was about helping low and moderate income people. These are, just who wouldn't help a low and moderate income person? It's in the Bible. I mean, like the community I grew up in, the inner city in Detroit, the low and moderate income people, who would argue against that? So it was an apolitical law from 1995, from 77 through 95. And it only became political when Trump got into office, because at that point, he brought in two bankers. You might remember Joseph Odian and Mnuchin, OCC and Treasury. And they had problems when they were doing the One West IndyMac deal, the sale to CIT, with community groups in California. So instead of focusing on the number one issue at the time facing bankers, which was BSA, according to a St. Louis Federal Reserve study, they went and focused on CRA because they had issues with it. And they came out with an NPR, and then they had the FDIC join them on the final rule, but the Fed would not join them. And so it was the first time we had a major split in the regulators, but it was quite political at that point. And then, of course, when Biden got in, he was very close with the Fed. He appointed people, Janet Yellen to run Treasury. He had different people, appointees. And as a result, what happened was the Fed went their own way. Really, the result pretty much of Lael Brainard, who was in charge of that. She had her own September 2020 ANPR, and that became the basis for the final rule that we had in 2023. So the first thing they did, of course, they rescinded the Trump, what I call the Trump CRA, and then they put in the Biden CRA, which is really what the final rule was. But the only apolitical rule was what I call the Proxmire CRA, what we had in 77 and 95. So the Proxmire CRA was apolitical, and then it became political with Trump, and then that was killed, and then it became political with Biden. And of course, as you just mentioned, that was rescinded. So now we're back to the 95, and that's my hope. I pray that we can keep CRA non-political, apolitical, and just focus on LMI communities, small businesses, what we're supposed to be focused on.
Yeah, and I'm just going to jump in real quick because I think and please correct me if I'm wrong, but one of the primary purposes of the 23 CRA rule was the growth of online mobile banking, kind of branchless banking type facilities, and how do we address that in the framework of CRA? So at least that's my understanding. So how do we? I guess, and I agree with you. I think this, I've always been a huge advocate of the 95 rule because I think, quite frankly, that is consistent with the legislative spirit in giving back to those very areas where we're removing or taking deposits from. So how do we address? I mean, I guess how do we address the concern that a lot of the advocates have of online banking and making sure that we are giving back to those very low, moderate, or underserved areas, consistent with the spirit of CRA?
this is where the problem started. There was a study I actually worked on with Treasury in 2018 when Trump got in, Trump won. And everybody agreed that CRA needed to be modernized, okay? Because in 1995, we didn't have the kind of digital banking, branchless banks that we have today. So everyone agreed that it needed to be modernized. So what happened was when things get politicized, they take the modernization argument and use it as a Trojan horse to say, we're going to modernize CRA, but we're going to do it in the political way I like. Trump did it in his way. Biden did it in his way. So they use the the modernization argument as a Trojan horse to get what they want politically. Neither one of them worked. As all we really needed was a simple rule to address branchless banks. What was the problem? These branchless banks, and I'm talking about the big credit card banks, Goldman Sachs, the big internet banks, the fintechs, what do? They take over 10%. We have about 22 trillion of deposits in the nation. Over 10% of them, I determined, are brought in by these branchless banks. And the problem is they take those monies from all of our big cities mainly. And all the CRA benefits, which I've determined to be about 40 billion a year, go to three what I call sanctuary states, which are Delaware, South Dakota, of course, you know, the whole Utah, and we're talking about Salt Lake City, Wilmington, and Sioux Falls, where these branchless banks are mainly located, because that's where their one single home office facility is, the facility-based, assessment area. And so what I proposed back in 2018, and I met with Adi, and he invited me to his office 2 or 3 times at the OCC, I proposed my 5% rule, which was very simple, that's all we needed for modernization, that anytime a bank takes more than 5% of the deposits from any area, metropolitan area, MSA, whatever, they now have a CRA benefit. But it doesn't go back to the people that it came from, but it goes back into the LMI area. So the money might come out of New York, the Upper East Side, but the CRA benefits will go back to the Bronx and to Harlem. So that's what we needed. So in summary, modernization, everyone agreed was needed. And as all we needed was a simple fix on the branchless banks. But unfortunately, the politics got involved and people put in what they wanted. And that's where we are. But now we're back to the 95 regs, but we still don't have a cure for modernization.
Yeah, back to where we started, back to the future, I guess. But in the OCC 2020 CRA rule, which was adopted under Otting, they did have a component that did address where the deposits were located, which wasn't exactly what you were proposing, but it was a response to it. It was an attempt. Whereas the 2023 CRA rule went a little crazy, actually. It identified all these new assessment areas, but they had nothing to do with the deposits. They were strictly based on where a bank was lending, and totally the antithesis of what you were advocating. So under the 2020 CRA rule, basically, if a New York bank originates one mortgage in Los Angeles, that becomes a part of the outside retail lending assessment area in the 2023 CRA rule, and they have to evaluate it as if it's an assessment area just because they did one major product line loan in Los Angeles County. So tell me about the Otting rule and where it may be, what you liked about it insofar as the deposit situation is concerned, and where you think it fell short.
Yeah, I was honored by the fact that Joseph Otting invited me. I met with him a couple times down in Washington at the OCC, and I explained to him the need for modernization. So he had all this other stuff he was going to put in CRA, but he agreed. He said, that makes a lot of sense, Ken. So he took the 5% rule, my 5% rule, which I said was just for MSAs, but he broadened it to the state. So he used the 5% rule, which was really a deposit-based assessment area, unlike what you just mentioned, when the ORLA and the loan-based, those were loan-based assessment areas, which made no sense whatsoever, because CRA is about deposits. And so that was the one redeeming feature of the Trump CRA, if you will, that they had that. And of course, that was immediately fought by whom? The branchless banks, the big banks. They said, oh, well, we are not required to report where our deposits come from. Well, let me just tell you, I've been in banking for over 50 years. Every banker knows where their deposits come from. Deposits are the building block of a bank, the raw material. We input deposits and we output loans, okay? Every banker knows, and I'm talking about every community banker listening to this podcast, every big bank, they know exactly where the deposits come from, down to the zip code. And if they don't, they should not be in banking, period. Because banking is based upon bringing in deposits. That's the lifeblood of banking. We all know where those deposits come from. Some banks down to the census tract. I've even talked to the big branchless banks. One of them told me, they said, Ken, we checked the 5%. We would only have 7 markets that affected. And what are they? The big markets: New York, LA, Chicago, Houston, Dallas, San Francisco, Miami. This is where the money comes from, the big markets. But the CRA benefits go back to Salt Lake, go back to Wilmington and Sioux Falls, which is wrong. So they all collect that data. But that was their argument. Why? They don't want this rule because now they would have to put money back in those communities that where they're getting the deposits from. And that's what we want. That's what we need. To Otting's credit, he did that. The Trump rule had it. But, when Lael Brainard got involved at the Fed, she totally changed it around and did not have anything to do with branchless banks. In fact, she continued, the status quo, which is where we are now. Branchless banks can do what they want and continue what I call weblining. Weblining is the practice of sucking money out of our big cities and putting it into where you've got your one facility based in Salt Lake, Sioux Falls, or Wilmington, and not reinvesting. CRA is about reinvestment. That's the middle name, not reinvesting back into the LMI communities from which it came. So that's basically a long answer to your question.
Yeah. Well, hey, now that the 2023 CRA rule is about to be repealed, it's not yet repealed, of course. So, don't cut your chickens before they hatch. Who knows? But can bankers really forget about the 2023 CRA rule, or what lessons do we have to learn from that rule? What do you think, Ken?
Sure. Well, the first lesson we have to learn is when things get political, they get bad. Like everything in life, when it gets political, 50-50, it's no good. Okay. So first, we have to take the politics out. Second of all, if you don't do that and you come up with a complicated, convoluted, the most complicated regulation in the history of American banking, like we had with this 2023 final rule, you are going to be sued. And this is exactly what happened. For the first time in the history of American banking, all of the major trades, ABA, ICBA, BPI, they all got together and agreed, we've got to challenge it. They took them to court. And I was very much involved in that. In fact, I submitted an amicus brief in support of that industry position. And what happened was the regulators knew they were going to get beaten so bad that they just decided to withdraw and rescind it. Otherwise, they would have been beaten, no question about it. Even if it went to the Supreme Court, we would have won. So the second rule is if you do something crazy politically wise, you're going to end up in court again. And the third thing we learned from this is you must focus on what the purpose is, and that's modernization. We need to address this weblining. The 23 rule did not do it. So like you said, Len, we're back to where we are. We've got to address it. And the lesson we learned from this is if you do it right, there won't be a problem. But if you do it wrong, there will be a big legal issue. We've got to get this right. And unfortunately, it was not done right.
So, yeah. And I was just thinking too, I mean, given the appetite, I guess, that we've seen coming out of Washington, do we really think that the Trump administration will be satisfied with this rollback without something to replace it?
I think they've got so many other things on their plate, and we're not going to get into the tariffs and everything else going on, but they've got so much on their plate that they don't want to have another big issue. And remember, CRA, you can fight CFPB, okay? You can fight fair lending, 1071 based upon your political views. Okay. But CRA is about helping low, moderate income people. Who wouldn't want to do that? And so I think even Trump would agree that, look, the law that's very simple and makes sense, but we've got to do something about this branchless banks. And if we could bring in $40 billion to these communities, 10% of that alone goes to New York City, by the way, $4 billion a year to help New York, and then another, $4 billion for Houston and Dallas. Who wouldn't argue with those monies? So I think they would agree that we need to just keep the 95 regs. And I think if they're smart, they'll just say, let's go back and do what Auden said, that 5% rule. It worked well. It's very simple. And it could be adopted in the same way that you did ORLAs and retail lending assessment areas. We could adopt without changing, without Congress getting involved, we could have deposit assessment areas like we had under the Auden rule, a very simple 5% rule, and we'll be done with it.
That's a good point, Ken. But what I'm concerned about is, and you were just saying that the Trump administration's got so many things on their plate right now that this is kind of just one of many issues, and it may get neglected. I'm afraid the administration might settle with just rolling back to the 1995 rule and leave the quote modernization or the need for modernization alone, which means it sets it up for the next administration to go back in and just say, oh, the Trump administration didn't modernize the Community Reinvestment Act, so we've got to do it. And of course, we saw what the Biden administration thought of modernizing CRA, which was unbelievably complicated, as the word you use and I've used many times, is convoluted. It was crazy, but way over the top of 1,500 pages of regulatory gobbledygook when something simple could be done. So I am concerned that they'll just stop with, rescinding the 2023 CRA, going back to the 1995 rule, and that leaves open the quote, the need to modernize. And that'll be the excuse for some future administration to come back and Katie bar the door. Again, you're going to have another version of the 2023 CRA rule. So I firmly believe that they can't stop with just repealing the 2023 CRA rule. They've got to do something to show that they're addressing the need to modernize the rule. And if they don't, they're leaving a political vacuum, which the next administration will rush right into, and who knows where they're going to take it. So I hope that there's somebody from the Trump administration is listening in today. I had the experience of being a state senator, so I've been involved politically myself, and I know how the laws are made, basically. And so politicians abhor a vacuum. And so if the Trump administration doesn't address this, then I fear it'll be the excuse for the next administration. And and the problem is every banker listening is thinking, wow, we don't have to deal with the 2023 CRA rule now, which is complicated, convoluted regulation way over the top. But they got to be worried, because if this vacuum is still there, the need to modernize CRA is still there, then it's going to be addressed. And you're going to talk about regulatory whiplash. The next administration comes in is going to do something about it. And what you, the bankers, are doing today will be subject to examinations 3 and 4 or 5 years from now. And so they can't really let their guard down because the exams are retrospective. And one thing I'm finding out, Ken, and I'd like your feedback on this, we've got clients all over the country. And in the last few months, we've noticed that even though the Trump administration has proclaimed it wants to deregulate, what we're seeing in the field is that apparently the examiners haven't got that message yet, because I've seen several cases where the examiners basically said, oh, okay, your assessment area to one of our client banks, which the bank had for many, many, many years, without criticism, the examination team that came in earlier this year said, oh, your assessment area is too small. You've got to expand it to embrace this nearby city, which was not in their assessment area. And again, this has been going on for years. And the new examination team insisted that assessment area had to be expanded. And if they went along with that, it had profound consequences for the bank, because obviously the low mod tracks jumped up considerably, and they don't have a branch anywhere in the city or near the city. So they're a tremendous handicap. So concerned not only about what a future administration may do if there's a vacuum there, but I'm concerned about, are the examiners themselves, do they have the message that, that the rule that had been set up under the Biden administration, even though it's going to be formally rescinded in another few months, that they shouldn't be taking the aggressive approach that was embedded in the 2023 CRA rule. What do you have to say about that? What's going on in the field, Ken? Do you get some feedback on that yourself?
Sure. Len, first let me address the other point you made, which was an excellent point about the vacuum with the rule. Unfortunately, you're right. That unless we address modernization, we're going to leave this vacuum open, and we're leaving the door open for some future administration. And you know why this is going to happen? Not because of lack of interest, but because of the big branchless banks. I'm talking about the really big Goldman Sachs, Morgan Stanley, Ally Bank. These banks, they have such political pull, so many lobbies, that they're going to do everything they can to prevent the 5% rule. And what's going to happen is they didn't mind the 2023 rule because they've got strategic plans, and they were isolated from it. It didn't affect them at all. So they didn't care how it affected the other, 4,500 banks, but they were protected. And that's the problem. Nobody wants to go up against the big branches banks with their political power, because that needs to be dealt with. So unless that happens, we're going to have that vacuum problem you mentioned. Now, to the second point you mentioned, again, true but unfortunate. So many of these examiners, the Fed, FDIC, and OCC, they learned the 23 rules. And you know what? You can't unlearn what you've learned. It's got to be an entire assessment area, the entire county. Well, guess what? As you've explained in your previous podcast about the situation like in LA County, that's totally unfair to a community bank. So they said, well, we could change it, this and that. The problem is they've done so much of this, but we have to remember what I always tell bankers, three basic rules. Number one, we work for our shareholders. No shareholders, no money, no capital, no bank. Number two rule, we have to have good relations with our regulators. And if they come in and our EIC says, add this county or remove this county from the assessment area, under the 95 regs, we made it very clear. The assessment area is a board decision. We make it. However, when they come in and say, take it out, whatever, we don't want to fight them. So that goes to rule number three. If you've got to fight them, you go out and get an expert like yourself or someone else to fight them. Good cop, bad cop. But you keep good relations with those examiners, with those regulators. But that's exactly what's happening, what you said. And we're seeing it across the board in big cities like, Chicago, for example, a suburban bank with maybe one office in Cook County, and all of a sudden they're forced to take all of Cook County, and it really ruins all of their LMI ratios. There's no way they're going to get passing on LMI, GO, or borrow. It's going to kill them. Same with, like you said, LA County, the big cities. So that is unfortunate, but that's what we're seeing out there.
Mm-hmm. Well, we're knocking the 2023 CRA rule, and rightfully so, because I think it was way over the top, unbelievably complicated. But in my opinion, Ken and Dean, there were some lessons to be learned from the 2023 CRA rule. For example, one thing I've been seeing as an increasing problem with our clients is a lot of the community banks, for example, are adopting a much broader market for their small business and their mortgage lending. Okay. And what they're doing, they're not funding that lending activity with deposits. They're funding it with sales into the secondary market for these loans. Right. And so what's happened is a lot of these banks started having problems with the assessment area ratio, which, as we all know, the regulation demands that at least half of your loans or more must be inside what is your official assessment area, your market, right? But these banks that were adopting these community banks that were adopting these regional and even national markets as a business strategy, and were being very successful at it, were running into problems because the assessment area ratio all of a sudden went below 50%, and that's almost always a prescription for failing your CRA exam. You're not doing enough lending in what you've declared as your market, right?
Yeah.
And in the 2023 CRA rule, they actually had an approach to determining the volume, the adequacy of a bank's volume of lending inside its assessment area. It was called the retail lending screen test, which is, it took the loans that were in the assessment areas and the deposits that were in the assessment area, calculated a ratio and compared that to all the other institutions that had depository facilities inside the assessment area. And that was one of the good things about that aspect of the 2023 CRA rule, because this has been definitely a growing problem ever since the advent of the secondary markets. And so we talk about CRA modernization and deposits, but also the use of the secondary markets creates an issue too. What are your thoughts about that, Ken?
Yeah, your point about the few good things in the 2023 rule. I mean, when you have a rule of 1,500 pages, let's face it, there's got to be something good in it, right? And but for example, the CRA list of CD list of qualifying activities in there, that was good.
Yeah.
The pre-qualification of CD activities, that was good. But guess what? Where did both of those things come from? They came from the out in 2020's, his final rule.
Right.
They took those out. And the one thing I like, I have to tell you, is the publication of the CRA public file. When a bank calls me and they say, "Oh, Ken, we are having trouble with CRA investments, whatever, what do you think?" The first thing I do, I go to their website and I look to see if they've published, if their CRA public file is online. If it is, it tells me something about that bank, about their CRA officer, about their, compliance officer overall. That's a good thing, it tells me, because I believe these should all be online. Now, remember, that was a requirement in there that came in early, that was removed and all that, but I think that should be online. Now, to your point on the assessment area percentage, you're absolutely right. We have banks with, 12, 15, 20% in their assessment area. And some examiners can say automatic needs to improve. And you say, no, there's a way to get around it. The idea like, oh, we got to go to strategic plan to get around it. That's a mistake. And let me tell you, from day one, I've been opposed to that strategic plan idea. That we did that back in 95 for limited purpose banks, very special credit card banks, limited purpose. We had a special, but if you're a traditional community bank and you've got that low in-out ratio, there's no reason to do a strategic plan. I could talk about that in length, but there are other ways of getting around it. Namely, as you mentioned before in your podcast, Len, the performance context. That's a very important argument to get around it. And also, other ways, depending if you're an ISB or a large bank, there are other ways, for example, through the investment test, through the CD test to get around it, even with that very, very low inside ratio. So I would caution banks, don't jump into strategic plan automatically thinking it's the way to go. Because remember, the examiners are all on top of this, the regulators, and they know a lot of banks are looking at that as a get out of CRA jail free card, and then open up on it. And it comes with a lot of problems that we don't even want to get into here, but there are other ways of dealing with it. But you're exactly right. There were some good things in that 2023 rule.
If Dean, if you don't mind, Mike, just continuing a little bit on this.
No, please. Yeah.
Another good aspect of the 2023 CRA rule answered a question that I've been confronting ever since 1995, when the quantitative standards were implemented for the first time. Before that, it was highly subjective, and that was a complaint from the banking industry. There was no quantitative measurements. So the 95 rule brought that in. But the problem is that we know in these tests, for example, lending, what they call the geographic dispersion test, lending in the low and moderate income tracts, we know and have known that the regulators are taking a bank's results and comparing them to the results of other banks that are active inside the assessment area. So if our client bank, let's just say, had 10% of their loans in the LMI tract, well, is that good or bad? Well, the way the regulators look at it, they looked at what other lenders were doing and what their penetration rates were in the assessment area. And they also looked at certain demographics. The problem was that while we knew what the comparisons were, we never knew what the calibration points were. Exactly. So your bank's doing 10% inside the LMI tracks, but the market's at 12 or 13%. Well, does that mean you have a need to improve because you haven't done enough? And in the calibrated benchmarks that were adopted in the 2023 CRA rule, they actually have precise calculations for that. So, for example, to get at least a low satisfactory performance rating on either the geographic test or the borrower characteristics test, you had to get to at least 80% of what the average was for the market that you were in. In other words, by all your competitors. They had an alternative to the demographic variable as well. It was going to be like 60% of that. But for the first time, I could confidently say to a client, oh, okay, you're at 9%, the market's at 10% or 12%. You're going to get a needs to improve, or no, you're going to get a low SAT. And that's something that I think by addressing that, it helped clarify what was a very cloudy issue and has been a cloudy issue for the last 30 years since the 95 rule was implemented. And uh, again, Ken, you're an expert in this stuff. You've written a book about it. The one thing I didn't like about the calibrated benchmarks that they had in the 2023 CRA rule was they couldn't stop there. Then they added all these iterations where you had to compile the ratings and weight them. And it was so complicated. If they left it just at those calibrated benchmarks, I thought that was great. It would be more or less like a guideline so anyone could tell, oh, 90% compared to the market is going to get me at least a satisfactory. But if I'm at 78%, I'm going to get a needs to improve. What are your thoughts about that, Ken? The idea of providing clarification.
And I think we've seen some of that. I'll let Dr. Ken chime in here on that. But I think, haven't we seen them, the regulators, even though they're talking about rescinding the 23, they've applied some of those calibrated benchmarks, Len?
The trouble is that everything's off the record and nobody will ever acknowledge it. This is it. I mean, Ken knows this too. Is like the examiners, they'll always talk to you and say, well, this is not official, blah, blah, blah. So one examiner might say one thing and another. And so we've never known precisely with any reliability what the calibration points are. And honestly, Ken and Dean, I'm telling our clients right now, hey, why would they have proposed the calibration points if they aren't already using them, right? Yeah. I mean, why would they propose something different than what they've been using? But it's unofficial and you can never be sure. But I like the idea of making it explicit, putting it in writing. What do you think, Ken? Do you think that's like too arbitrary, or what's your thought on that?
This was a question I had back in 1995. I was invited, Senator Proxmire introduced me to Gene Ludwig at the time, who was doing the OCC, and I worked with Steve Cross and all the great people at the OCC coming up with the 95 regs. I had lunch with Proxmire, not with separately, but with Ludwig, and he said, well, Ken, what do you want in the small bank rule? I said, because remember at that time we just had small and large banks, and I gave him these four tests: loan to deposit, in-out ratio, LMI, geo, and borrower. And I specifically said we need to do objective. And I said 80% loan to deposit for outstanding, 65% high SAT, low SAT. I had a whole breakdown. And then the same with the in-out ratio, at least 50%, 80% outstanding, and so forth. Now, the 95 regs, they never put those in. They said that would be too much. And actually, you have to remember, we had a 93 reg, and then the Fed fought it. We had a 94 reg, the Fed fought it. That was Larry Lindsay. And finally, we got the 95 regs that were approved. But the point was, we tried to go objective back then, and it was opposed because the examiners wanted some subjectivity on it. So fast forward to where you're talking about, there's no doubt that today, and it just depends upon the examiner you get. If you get a really good examiner, experienced EIC, they will properly use these calibrated benchmarks. They may not use 16, 80%, but they will go to the demographic relevant, and they will look at the peers, and they will compare what you've been doing. And 60, 80 is just too objective to use across the country. Every market is different. It might be based upon the economic or competitive situation in a certain market. It might not be 60, 80. It might be, 50, 70, or even lower. Who knows? So that was the problem when you try to get too objective. It just doesn't work. It broke down. But you're right. The idea works. But examiners can use that now, and they do use something like it. But it depends on who you get. Unfortunately, all of our very top CRA people at the very high level, like at the OCC, Grovetta, she left. Barry Whitus is gone. Pam Freeman at the FDIC. Some of the very, very top people have left. They've taken early retirement, and we don't have a lot of the experience that we used to. And that's a concern I have going forward because we don't know who's going to come in, who the EIC is going to be. Are they going to be experienced or not? We're even seeing this on the safety and soundness side. So it all depends on who we get. And what that means is, again, we go to good cop, bad cop. We have to train, we have to educate these examiners as to what the appropriate benchmarks might be. And if it's not 60, 80, and we don't meet that, why it might be 50 or 70 or 40 and 60, and why that's good enough to do a passing rating. We cannot just, accept what they bring about. We have to sit down and talk with them and explain performance context, why our market is different. Why are we unique? And our performance context dictates very clearly that my CRA performance must be measured relative to the context of my county, my assessment area, not somewhere in New York or Chicago or LA. And mine is different, and we have to explain why. And if you do a good job, and most banks do a good job serving their community, they should avoid, a needs to improve, even with a very low in-out ratio of under 50%.
Yeah, well, I just abhor vagueness. When you're going to be tested, subject to a test, you want to know what the standards are, right? And because otherwise, examiner A could say, "Oh, you're doing great." Examiner B could say, "You're failing the test," right? So to me, at the very least, there ought to be the calibrated benchmarks ought to be published as guidance, okay, not necessarily absolute rule of thumb, and it's always going to be tempered by the performance context. The good thing is by using the performance context, which is, of course, like 80%. All right, let me just go back. What's satisfactory lending in low mod tracks in one part of the country could be abysmal in another part of the country because it's all subject to the local performance context. But by comparing banks to other banks, well, obviously in New York City, lending in the low mod tracks, what's satisfactory there and what the experience is going to be totally different from some rural county out in the middle of Pennsylvania, right? So by saying, "Oh, we're going to compare you to the other lenders and the local demographics," that itself is a built-in adjustment to allow for the performance context. And just saying, okay, so 10% in New York City might be terrible lending in the LMI tracks, but it'd be great in in Fairfield County, Connecticut. And so that itself is a form of adjusting the standards to reflect the performance context. And the regulation has always said that, and I know you preach this too, you go to these webinars or these seminars run by the regulators, they always say, be prepared to tell your story, which means what's going on in your community. So a banker's always got the opportunity to wiggle out of a problem if they know what the results are, they know what the standards are, and they know what's driving their comparison to the standards. And we had a client bank last year who they were accused of not lending enough in the LMI tracks. And, the market was at whatever, 10%, they were at 6% or something like that. But what we found was that a lot of their mortgage lending in those tracks was multifamily housing. So, and the problem with the regulation is just taking one mortgage. It doesn't matter if it's a mortgage for a 200 unit complex or a single family home. You're just getting credit for one mortgage in the lower moderate income tracks. And that's part of the calculation. So what we said to the regulator, we said, okay, so our client bank's got 22 loans in the LMI tracks, but they financed 680 living units. So it's the same thing as extending 680 mortgages. And if you take that into consideration, guess what? Their performance actually was it wasn't a need to improve. It was an outstanding performance, basically. But that's where you gotta, you temper the rule with the performance context factors like that. And sometimes you actually have to lead an examiner to that conclusion because they're expecting you, the banker I'm talking about now, our listening audience, to know the story and be able to say that. You can't rely on the examiners to go out of their way to try to understand the performance context. It's your responsibility as the banker to know your community. You know it, and you should know it better than any examiner will ever know it. And it's your responsibility to take that on and to explain it to an examiner, and they can temper their judgment about your performance in light of that. All too many bankers go in like deer in the headlights, just blindsided, and I didn't know, that we're going to get a needs to improve because we're not doing enough lending in the low mod tracks. So I think that's where, see, I'm going to get on my soapbox, but that's where I think CRA not only needs modernization, it can be improved dramatically with very simple things like having a calibrated benchmarks. And I've got some other ideas, which I'd like to bounce off of you, doctor, during this, because you're the man that wrote the book about CRA. So as we continue this discussion, I'd like to talk to you about things I would love to see the Trump administration introduce to CRA, not just to modernize it, but to make it a more effective and a more accurate measure of a bank's meeting the need for credit services in the community they serve. I'm monopolizing these things, so I'm going to shut up for a while and let Dean and you two guys talk for a while. So what are your thoughts about that? And then Dean, of course, chime in too.
Yeah, I mean, one of the things that I know bankers have always kind of struggled with under CRA, and we haven't really talked a lot about it today, although we've talked a lot about CRA and some of the flaws of CRA, of the 23 rule, and some of the things we like about the 23 rule, is discussion regarding the community development pieces. Because that's always been, as you know, both of you, I know, Len, we've worked on in numerous cases where there's so much confusion and also a lack of community development originations. And so how do we address that, I guess? And do we feel like the 23 rule came close to covering some of the concerns surrounding community development? Or is this, again, another opportunity for banks in the NPR to get involved and say, this is what, an easier way, I guess, in order to look at community development loans, investments, and services? Can you talk a little bit about that community development piece? Just because, again, I think it's always very important to the banking community, and it's been a challenge over the years.
Sure. Well, first, I want to go back to Len made a point which was really excellent about multifamily lending. And this is also true for construction lending. And this is very important. In fact, back in the 90s, I worked with a bank. I was helping them. They were in New York City, and they were doing no 1 to 4 family lending. They were doing all multifamily B and C properties, not Central Park, but in the Bronx and Brooklyn at the time when Brooklyn was affordable. And so the examiner came in, and the EIC, I sat across the table from him. The bank president was there. The examiner was there, the EIC. And the EIC said, you guys have done no 1 to 4 family lending. I'm thinking of giving you a substantial noncompliance. My examiner thinks that you've tried with the multifamily, so he says it needs to improve. Now, the bank president says that they're doing a good job. It should be satisfactory. And then he pointed to me, the CRA consultant. You think the bank should be outstanding. And I explained, yes, they should be, because first of all, we're in New York City. This is not Long Island. We don't do 1 to 4 family loans. What we do are multifamily B and C property. And the regs are very clear. And this is important, whether you do multifamily or construction lending, that we look at the ultimate beneficiary of that money. Not that we put it, a $10 million check to an LLC in the Bronx, but that we're creating 200 or 300 LMI units. The ultimate beneficiary. The regs are very clear, whether it's construction lending or multifamily. Now, once we understood that, and in this case, think about that. All 4 ratings were on the table at the same time. Noncompliance, needs to improve, satisfactory, and outstanding. That shows you how subjective CRA was. Ultimately, they got satisfactory because they were able to understand the concept that the money eventually helped LMI people, even though it was a multifamily. Not one big loan to a rich person, but to the LMI people that it was helping. So it is up to you as the CRA examiner to understand that. And if you, as a CRA expert at the bank cannot explain that, then that's on you. You have to explain that, show them the regs where the regs are very clear that it's the ultimate beneficiary of the money that we evaluate. And whether it's construction lending or multifamily loans, that is going to be good CRA. So again, I'm sorry to get carried away on that topic, but I actually wrote a whole case study about it in my CRA handbook. The EIC at the time, he was not happy. I said, I said to him, I said, I have to thank you very much because you finally opened my eyes. I realized the problem with CRA is not with the banks. They're doing a good job. It's with you, the examiners. And in fact, I'm going to write a chapter on you in my new book. And the guy looked at me, I swear. He said, you do. I'm going to sue you. I'll get the lawyers. I actually wrote a chapter about him. I didn't mention his name, but that was very helpful to me because it explained to me that the real problem with CRA is not the banks because they're doing a job of serving that community. It's with the examiners not being able to properly understand performance context.
Mm-hmm.
Yeah. And then they excluded multifamily into the new Stat 23.
Yeah.
So it's kind of like, what?
Yeah. Isn't that crazy?
Yeah. It really is crazy. Yeah.
You raise the topic of community development, and man, and by the way, Ken, if I'm correct, you founded 2 community development funds, right? If I'm not mistaken. So this is your bailiwick for sure. Not that, CRA altogether, but community development specifically. And I have a complaint that I think can be so easily rectified in a new rule. And that is that when a bank's performance is being evaluated, we just talked about performance context, right? Well, to have performance context, you need data. You need to understand what's going on in the market. My complaint about the legacy rule, which we're going back to, is that banks that report their community development activity report it only in summary, that they did 52 community development loans worth $500 million or whatever it is, and you have no clue about where those loans are. You have no clue about which community development purpose is being fulfilled, etc. Now, the crazy thing is this, that for a bank to get credit for that claimed activity, they have to have the documentation to back it up. When they go to an examiner during a CRA exam and say, oh, we're claiming 22 loans worth X dollars for community development, the first thing the examiner is going to say is, well, where were they? What are they for? What community development purpose do they fulfill? And what documentation do you have to substantiate the qualifications, right? And so, but the reporting, B of A reports hundreds of community development loans worth tens of millions of dollars, but they're recorded only in the headquarters of the bank itself. You have no idea where in the entire country, let alone in a county, they put these things. And so I think since the banks need to have this data available for an examiner to get credit during the exam, why aren't they reporting it? And if they're reporting it, that means that everybody will be able to compare the activity going on in a given county, just like they do with small business lending and small farm lending, right? Yeah. So I want to hear you get up and talk to me about that, Ken. What do you think about that idea of mandating the reporting of more detailed community development activity?
Len, I agree. In fact, we had that before. Remember, when it originally came out, all banks were required to do that. And then the bank said, oh, regulatory burden, and they removed the small banks from doing it. And all of a sudden, the data was no longer valuable, especially for community banks. So I agree we need better data there. But I want to go back to the point Dean mentioned about community development. And I have to tell you, when I get contacted by a lot of banks and I read every PE that comes out. I mean, I've read over 40,000 of, 80,000 PEs. And I can tell you right away, I can look at a bank, whether it's a small bank, an ISB or a large bank, and I can tell you what they think about CRA by looking at the community development investments. Okay. CD loans, they're hard to make. They should be made. We need them. Okay. But, some banks have all different priorities, different market segments, different niches they're in. CD investments are very clear cut, but CD services, there's only so much time in the day. CD investments are what I've referred to as a get out of CRA jail free card. Let me tell you, if a bank does no CRA investments, and I'm thinking I use the 1% rule, which I developed back in 93, 1% of average assets. If a bank does not have CD investments of at least 1% of their average assets, whether it's a large bank or an ISB, then it tells me something like CRA is not really important to them because there's no excuse. You have an excuse if you can't make CD loans or even regular loans with competition, the economy. You have an excuse with CD services. You don't have the team, but there's no excuse that you can't write a check to do a safe and sound CD investment. I'm talking about government guaranteed, immediate liquidity that's going to help the LMI in your assessment area county, not broader statewide regional area. There's no excuse for that. Even a small bank, you can get extra supplementary credit for it. So the CD investments, when we put those in 95, it was like saying, well, if you can't do anything else, you could at least write a check. I'm not talking about donation. I'm talking about a CD investment for a government guaranteed investment, fully liquid, immediate, one day in, one day out. If you can't do that and you're not meeting what I consider my 1% rule, then don't complain to me about your other problems with CRA because you really probably don't care about CRA.
Yeah.
That's my view on CD investments. And that's why I started, like you said, 2 different funds and now the Community Development Fund.
It's funny, a lot of advocacy groups do the same thing that you just mentioned. They look at what the investment is. Of course, they reap the rewards and love the lending side of the community development. But as you indicated, they're looking at what type of investments. I mean, they always view the banks as big wallet individuals. So what are you doing to reinvest back into these low, moderate income areas, improving the community and providing opportunities? And so I agree with you. They're looking at that as well. And I think this is, again, banks can't be complacent here and just hope that a new rule will come out or that we can just revert back to the 95 rule and follow it. I think we've got to be proactively engaged in what CRA will look like in the future, for sure. Mm-hmm. No doubt about that.
On community development, just before we move on to another aspect, everyone knows that community development consists of 2 different kinds of activity. One is investments, like Ken has been talking about. The other is donations, qualified donations. And about 20 years ago, I had a discussion with the FDIC field review supervisor for here in New England. And I said, so, what's the rule? How do you deal with that? Because you make a $100,000 contribution and you get $100,000 worth of credit. You make $1 million loan or $1 million investment, you're getting 100 times the credit. So how do you equate the two? And what are your thoughts about that, Ken? Because you've been very active in the community development side of things. So when you're advising a bank regarding community development investments, which counts traditional investments and then it also counts donations, how do you balance those two? I'm curious to hear what your professional insight is on that.
Len, very important point. Examiners, especially, remember, I always say the question is, how much is enough? In fact, if you Google how much is enough, you'll see an article I prepared back a while back when I came up with the 1% rule. But it's not just in investments, it's donations. And they look at a bank and they say, we expect you to make donations. It's very important for a bank to understand it's better to give 10 $1,000 donations instead of one $10,000 donation, okay, to different community groups. It's better to give 10,000 donations instead of $100,000 donation. Spread it out because each one of those communities groups that you're helping, whether it's inside your assessment area or even a little bit outside, that they can help you when the time comes to give you support when you need it, for an exam or if you have a challenge by community group or you're doing an M&A, whatever. So it's important to spread out that money. And remember, once you start it, it's going to continue forever. Okay, so you got to be careful. And you've always got to be careful, too, about finding out which community groups are the right ones that are really helping the community, which ones that you might want to stay clear of. I don't want to say troublemakers, whatever, but there are certain community groups that challenge community, M&A a lot and so forth. And all of a sudden, you contribute to them and they expect, what are you doing here? What are you doing with this? Why are you opening this branch with this and that? So it's a very important decision you have to make at the bank as to where that money goes. But you need to have reasonable levels of donation to all your different community groups. And remember, some of them are going to have much more effect than others, but you've got to have donations because an examiner comes in and they see you're growing, you're doing M&A, you're opening branches, you've expanded. They expect you to help the community more than another bank of the same size. So the answer to question how much is enough, there are like 12 different answers I came up with. It's like if you're in a really rich area, like you said, Fairfield County, you're in Greenwich compared to, say, in Bridgeport and New Haven. You're growing. You're having M&A activity. You've opened branches. Those are things where we expect more from you across the board. Okay? Show me what you've done recently. Show me something new. Show me something different. And I expect more from you because you've done these additional things. Every bank's being treated differently. And again, there's no way we're going to have a reg that's going to have all that in there. But when CIC comes in there, they expect different things from different banks. You know what I'm talking about.
Yeah. I could always remember there was a CRA conference out in San Francisco. This must be 10, 12 years ago. And it was the biannual meeting sponsored by the Fed. And a guy got up from Fremont Savings and Loan. This is in front of like 1,200 bankers and regulators. And he talked about his exam experience the year before, in which the bank was going to get a need to improve rating on community development. So, and he was railing and going on and on about, he said to the examiner, well, okay, if our $10 million of community development investment activity is not enough, what is? And he said the examiner wouldn't tell him. He said, all I'm just asking for is just tell me so I have an idea what the standard is and we're going to beat it. So, and he complained loudly that he couldn't get any kind of an answer at all. And it was very frustrating. Well, 2 years later at the next biennial, he was gone. He wasn't there. I don't know what happened to him. But he was unabashed. He complained. And this is a complaint I get a lot of among my clients is that, again, the standards are kind of vague and uncertain, and they can be inconsistent. One EIC could take one view of something, and the next time around, another EIC could take a totally different point of view. And so there's a lack of consistency in the enforcement side of things. No matter how the regulation is written, they're still subject to their application. And out in the field, what's going on out in the field can be very different from what the regulation says. And I've run into that experience too many times. And I'm certain every banker listening to this is probably nodding their head. Yeah, I've been down that road before.
Yeah, my recommendation there is that there's a time and a place for everything, and the last thing you want to do is confront a regulator in those types of forums with that type of question. I would not encourage that from everybody going forward.
No Stockford's advice, rule number one.
Not highly recommended. They don't like to be put on the spot. While they like to be heard, they don't like to be put on the spot. So there is an avenue for dialogue in your exit and beyond. I would not choose that forum to confront the regulator for sure. But I'll digress from there. It's just a word of advice.
No, probably the best advice in this entire discussion we're having at this point in time. If you don't practice that, you're probably going to be history sometime soon.
Yep.
By the way, one way of satisfying investments, and Ken, I definitely like your impression about this, is you can open up a certificate of deposit at a minority-owned institution or a women-owned institution. And even if that institution is not inside your assessment area, you get credit for a community development investment. What are your thoughts about that, Ken?
Sure. That is clearly one of the qualified investments that we put in back in 95. And in fact, it's important that you understand for banks today, with liquidity the way it is, a lot of banks go to quick rate and other sources of buying deposits. And oftentimes they buy CDs from other banks, even minority or distressed credit unions and so forth. So what you need to do is to ask them for a list when you buy those broker deposits of any CDs that might come from an original bank that is a minority bank, because you can do it. Now, A lot of banks try to do it themselves. It was hard at 100, but at 250,000, you got to call up a bank. You're not going to get a rate. And they say, well, we know why you're calling. You're going to be calling at LA or in Miami, Hispanic bank. We know why you're calling, and they're going to give you a low rate. But then what I've learned is instead of getting a 1-year CD, a lot of banks will do a 6-month CD, for example, and let it lapse. And then 3 months later, they'll get another one. That counts for two, investments as compared to a 1-year CD. And so they kind of ladder it that way. Some examiners will treat it differently. But the point is, those are small numbers. They take a lot of trouble. My view has always been, and as I said, I've run these two major community development funds, CRA funds, that you have to have a government guaranteed investment, which is a CD is. It's got to have immediate liquidity. Even 6 months or a year is a long time for a bank that needs liquidity, but it's got to be in your assessment area. Now, that is true. A minority bank CD could be in LA and you could be a New York bank and get credit for it. There's no doubt. But examiners always like it when you're in New York and you go to, say, Ponce Bank in somewhere in the Bronx or, Carver Federal in New York. They like it more when you're helping a local, bank. But the numbers just don't add up. So that's why ultimately, to meet my 1% rule, you've got to go to other investments. And remember, one thing we learned from the new 23 rule, they like impactful and responsive investments, high investments. These usually mean LIHTC. So, for example, at our fund, 80% of the investments we do now are LIHTC investments. But remember my 3 rules on investments. It's got to be government guaranteed. It's got to have immediate liquidity for your CFO. And it's got to be within your assessment area county. It can't be a statewide municipal bond. It's got to be in your assessment area county helping LMI households. If it doesn't meet those 3 things, and I've been on boards of banks myself, I just say, pass, we'll go somewhere else.
Yeah.
Dean, do you mind if I ask Tom Ken another question?
Oh, please. Yeah.
You mentioned way back when in '95 about the banks and the reason why small banks don't report. They're not mandatory reporters under CRA. They can voluntarily report. I always thought, and this is based on my 30 years of experience, that that's an enormous mistake to not mandate the reporting by everybody, because all the banks are subject to performing under CRA. And if you're subject to perform under CRA, then it's irresponsible to not collect and track the data so you know if you're falling short. And if you're doing that, then what's the big deal about reporting under CRA? Especially the software. The FFIC provides free reporting software. So you don't have to go out and buy some fancy, commercial software if you're a small bank, and you probably don't need it if you're doing 100 small business loans a year or something like that. So I always, in the small banks, the community banks would benefit from reporting because they're responsible anyways. It's irresponsible not to collect and monitor your own performance. And with the limitations that exist right now, where only the large banks are reporting, that means there's no peer data because, again, out of the 4,300 banks, 600 to 700 report. That means 85% of the banks that are responsible for CRA don't report under CRA. Therefore, it's impossible to compare yourself to your peers, which I think is a major shortcoming and would be in the interest of small community banks to be reporting. And I'll say one other thing, and I definitely want to hear what you have to say about this, Ken. But I have found that many of our client banks that are community banks actually do very well in their backyard in competition with even the biggest banks in the country. It's their community. They know their community. They got this advantage. And when they're not reporting, what we do is we take the market rank. For example, we have special reports that we give to our clients when we're evaluating them, and look at the market rank and market share of all the banks that are reporting in the bank's assessment area. And we can interpolate. We know that if that bank did 52 small business loans worth $5.5 million or whatever it is, that if they had reported them, they'd be ranked number 5 or 6 or whatever it is. And I could tell you almost always the community bankers do a heck of a job, and they're not getting credit or recognition for it because they're not reporting it. So I think there's a lot of reasons why it should be mandatory. But even every bank listening to this, I think, should be voluntarily reporting their CRA data. And anyways, and you'll be surprised, many of them will look very good in terms of meeting the need for credit services, especially in competition with the big guys most of all. What are your thoughts, Ken?
No, I totally agree. And I was against the fact that they removed that reporting. And it was done in the way of, the argument of regulatory burden.
Right.
Not this regular. So you could say, well, we could, we could stop reporting CRA. We could stop reporting anything based upon regulatory burden. But remember, we are the most heavily regulated industry, not just the United States, but in the world, American banking. And there's a reason for it. It's because we give deposit insurance, we give charters, we keep out other banks. There's certain reasons, access to the Federal Reserve, discount window. We give a lot of public benefits to banks, and in return, we ask for certain things, including CRA. And so that data should be in there. I totally agree. And the other problem I see with that is, banks are to blame themselves because so many banks, and I'm not singling out any community banks, but they just don't do a good job of telling their story. And some banks have really good CRA officers. A lot of them are, former FDIC, whatever, but they do a really good job. They do an annual CRA audit, which I recommend, and they got to get it to the board. It's important that they every year, for example, in my opinion, every board meeting should mention CRA in one form or another, because the first thing examiners come in, they look at it and they say, does this bank really understand CRA fair lending? Only at the board level. But so many banks don't do a good job of that. They don't put it in their minutes, and they don't do a good job telling their story. They don't have an annual CRA audit. As I said, they don't put their CRA public file online. They don't meet the 1%, my 1% rule on investments. And it's very clear when an examiner walks in, you know right away if this bank cares about CRA. And if they just have one ratio bordering needs to improve, like assessment area under 20 or 30 percent, that very low, under 50, a low loan to deposit ratio, bad LMI ratios, right away we can easily argue that we can knock them in the needs to improve. So again, it's up to the bank, and many times the bank is its own worst enemy because banks do a good job helping the community, much better than many of the big banks for the reason you mentioned, but they don't do a good job in reporting it and explaining it and telling their story. And that is on the bank. It's not really on the examiner. It's on the bank.
Yeah, and I agree with you, Len. In Dr. Ken, I think that they definitely should be a reporter. I don't think there should be an exemption. But to play on your point, Ken, as well, and that is we're the most heavily regulated industry, and that, especially the smaller institutions, this is where it becomes a resource issue and an expertise issue. And I tend to agree with you. I think, folks are assigned the title or given the title of CRA officer without truly understanding what does that mean, and without putting the effort into, really shaping the framework for that institution, because they have all these other hats. It goes right, just like the data reporting. Banks they're caught up on the data integrity, not necessarily the importance of the important, but they get hung up on, well, if I get this little code wrong, then the regulators are going to hit me. And, gosh, it takes me all day long because I have to go through and scrub all of these reports. So why should I report if I'm given some sort of an exemption? So, well, I think, as software and technology advancements have been made, I think we need to rely heavily on those technologies to report the accurate information, the accurate data, try to reduce the regulatory burden as best we can. But I agree they should report it for multitude of reasons. I mean, it reminds me of HMDA, quite frankly, a little bit, in that the regulators expanded it. It's almost like they lost the spirit of what the rule is for, and they got all hung up on the data codes and expanding all of those. And, I really think that they kind of lost focus of what the purpose of the Home Mortgage Disclosure Act was. And I'm not going to go down that road today, but it's kind of similar, I think, Glenn, to this data reporting for CRA under the small business, small farm reporting component. So
if you're going to be held accountable, then it's imprudent and irresponsible not to be collecting the data and self-monitoring.
Yeah.
The worst way to start off a CRA exam is the examiner comes in and asks you, do you have anything about CRA if you're not a reporter, right? No, we don't. We don't have any collected, we haven't collected the data or anything. So number one, that gives the examiner the impression that you don't care about your CRA responsibilities. And number two, so what does the examiner do? They draw a sampling of your loans to determine how you're performing. Now, if you're not collecting and monitoring the data, that sample could be accurate. It could be way off the beaten path. You wouldn't know it. So you're actually subjecting yourself to a game of chance, and you're hoping that the odds are in your favor. And of course, the CRA exam failure rate is relatively low historically. It's about 1.5% or something like that. But in the 2023 CRA rule, by the way, it was going to increase to 10%. It was going to increase like 8 or 9-fold. And that was one of the bad things in it. But you can't, as a banker, count the goodwill of the examiner. You have got to be prepared. And if you're going to be held accountable and you don't have the data, then you have to be a masochist, I would say, to live under those circumstances. I mean, if I were working for you, Dean, and you said, Len, your responsibility is this and that, and at the end of the year, I come up for my review, and you go over my performance, and I don't know anything about my performance. You kind of look at me and say, well, you don't know about your performance. That means you don't care about your performance. You're fired, right? It's like, so I think it's a big mistake. I wish they would return to making it mandatory, that all covered lenders must report under CRA. And aside from the compliance aspect of it, there's actually a good marketing aspect to it. Again, because I've told you, many of our client banks do voluntarily report because we encourage them, like I'm doing right now. And they are shockingly performing very well in their local communities. And so they're the number one bank in some cases, beating out even the biggest guys. So they're losing the opportunity for a great marketing opportunity as well as a compliance responsibility.
Yeah. I agree with that. And I was sitting here thinking, wow, this has been just the most incredible natural discussion that we've had. What a perfect discussion for our 100th episode for sure. We've covered everything about the fatal flaws of the CRA, the 23 CRA rule and the rescinding of that. We've talked a little bit about the politics around it. We've talked about community development. We've talked about the deposit-based type facilities and the various assessment areas that have been contemplated. I think we've certainly given our audience some good advice along the way today, and maybe we should wrap it up by saying, what are each of us can say about what are 2 or 3 key takeaways that for those that have listened today, what would we suggest as we move forward from here? And maybe we should just make a couple of comments in that regard before we I'm not trying to end it early, guys, that's for sure.
I know just getting warmed up.
I know we can talk forever for sure.
No, this has been a great discussion, and I'll just quickly say, number one, at the beginning, if you're listening to this broadcast and it's prior to August 18th, 2025, that means you still have the opportunity to comment about the NPR, and you could add these other comments in that we've been talking about. And the way you do that is there's a website you can go to, government regulations.gov. Let me look it up. Actually, I got it here. And what you do is you click on the docket, and the CRA, you look under the docket for the CRA NPR basically, and you could then submit some comments at that point in time. And right now, as we're speaking, it's July 28th, as we're recording today, there's only been one set of comments submitted, and it's by guess who? Dr. Thomas. But typically, the community advocates jump on the bandwagon, and they send in hundreds and sometimes thousands of comments, so they tend to get skewed and one-sided. And it's up to the banking community to make certain that they are, that their side is vetted and has the opportunity to explain why this is a good thing. And it is regulations.gov. And just click on the docket, and I could tell you the OCC docket is 2025-0005, and that would be the docket number that you're looking for. Ken, go ahead. I don't mean to monopolize. I get crazy about CRA because I've been living, eating, sleeping, and drinking it for 31 years. You're probably one of the few people in the country that's done it even more than me.
Well, thank you, Len. And let me just say to the point Dee made as far as takeaways go, number one, what's most important to banks right now? I could tell you without a doubt, it's M&A activity. We're in a very deregulation phase, and every bank wants to jump on the M&A bandwagon. We just saw a big deal with the two big banks, Pinnacle and Synovus, and we're going to see many more. However, CRA, fair lending, can derail that. So it's up to you as a CRA officer to make sure this doesn't happen. And just because we got, Trump is in deregulation, we could take our foot off the gas. Big mistake. Remember, the DOJ uses a 5-year look back. And even in CRA, we go back on a review period, 3-4 years. So you say, well, we're now in 28. We have a new administration in. Well, what did you do in 25, 26, 27? Oh, those were the Trump years. We didn't have to do anything. The Trump deregulation dog ate my homework. I have no. You've got to keep your foot on the gas. All these things that we're talking about, you have to focus on. And again, that whether you're a small bank, especially ISB or large bank, or even strategic plan, there's no excuse for not having any CRA investments. No excuse. As long as they're government guaranteed, have immediate liquidity day in, one day out, and they're in your assessment area helping low and moderate income people, especially on affordable housing, our number one community need in every community in the country. If you don't have that, then really, there's really no help as far as what do you expect? As far as the final rule goes, as I mentioned in my comment, you've got to have the 5% modernization. The 95 rules worked. We're getting tremendous amount of community investment. Banks are doing well. Community groups are making money off these big CBAs. It's worked well. As all we need to do is to modernize it, update it. And that can be done with my 5% rule. Very simple. We don't need 1,500 pages to figure that out. 1,500 words in a couple pages could do it. Thank you all very much for the opportunity to be with you, and I look forward to doing this again.
It's been a true pleasure. I think the last time we had you as a guest, at least at M&M, was our compliance school several years ago in Massachusetts, and that was certainly a delight for our attendees at that school. So I appreciate that, and it's always a pleasure to see you and get your insights as it pertains to CRA. And this has been, in my opinion, probably our best episode, Len. I mean, again, we well over an hour. I know we could talk probably another hour or more. It's been fun, and I think our audience, I hope they I hope they can glean a little something from the passion that we have relative to CRA and get involved and really have an impact on what this looks like in the future.
Well, I want to thank Dr. Thomas for graciously appearing on today's podcast, and I'm certain we'll be doing more in the future. Ken, it's a pleasure to know you as a professional, as well as I consider you to be a friend. And let's move forward with CRA modernization. This is Len Suzio with Geodata Vision.
And this is Dean Stockford from M&M Consulting saying thank you for tuning in to our 100th episode. If there are future episodes you'd like to hear in the future, going forward, please reach out to us online, send us an email.